Hey everybody, welcome to Trading Capital. It is May 4th. Jumping into the S&P 500 here today, we're going to also be discussing the Federal Reserve, the FOMC interest rate hike that occurred today, and what's going to be transpiring in terms of the reduction of the balance sheet. We have some new information regarding that process, and then I'm also going to be answering a member's question. I think it was a really good question. It's going to dive into some of the Federal Reserve history and economic policy history, which is never a bad thing for educational videos. So jumping into the S&P here, we had a huge rally. You can see we put in this bottoming tail, and we've had a nice rally off of those lows right into resistance. It's pretty cool to see where you basically stopped today. You ran right into resistance here. Pivot low to your original breakdown line, your next pivot high, and now your another pivot high here. So clearly in the short term you are into resistance. There is a chance that you can pull back and consolidate sideways to move higher. However, now if you look at this move, you're now in the middle point of this channel. Basically on a risk to reward basis, it's now a 50-50 in terms of whether or not it's going to go up or going to go down. So the risk to reward is not really the best anymore. The market's had a tremendous rally, and you kind of have to be positioned before this rally. So right now it's in no man's land. I'm in the camp that you potentially can go a little bit higher in the short term. However, you do need a little bit of consolidation, but the overall trend here, we still see the markets heading much lower. In the event that you get through this blue trend line, your next level of resistance is going to be right over here. That'll be your next big one. And once we get into this level, we will be looking to start accumulating short positions on the spiders, and then anything higher up here, we will also look to accumulate shorts here and anything at the top of this channel. So there's a couple key levels here, 1, 2, and 3 levels of resistance where we will be looking to start accumulating short positions. But this is a beautiful retrace back to this mean trend line, and we'll just see how much resistance this truly is. Overall trend still heads much lower, but the fact that the markets now have that rate hike of 0.5% baked in, as well as the Jerome Powell was very cool, calm, and collected. He managed to soothe the markets today and calm them down and provide them some assurities by saying that he and others at the Federal Reserve think peak inflation has hit, since a lot of the PPI readings are now declining. I don't personally think that. I do think we're near peak inflation, but I think inflation it may come down from the peak, the highs, but it certainly won't go back to the baseline, their baseline target of 2%. I think they've upped that to 3%, but even that, it's going to be hovering more like probably 7%, and then 6%, and then maybe into the 5.5%. But between 4 and 5% will probably be eventually our new normal mean target of inflation. So let's discuss what else is happening in terms of the economic policy. Along with the 0.5% hike, Jerome Powell was a little more dovish in the sense that they said that he's not considering a 0.75% hike, so a 3/4 basis point hike, which is obviously bullish for the markets because it now means that the worst case scenario for the next interest rate hike is 0.5%. So there's no real gray area there. There's no fear a 0.75% hike unless he rug pulls us. But I don't think that's going to happen at the moment. And the other crucial part that does make him more dovish as opposed to hawkish is the sense that he was throwing around that $95 billion before this meeting. We heard it in some Fed minutes regarding, practically reducing the balance sheet by $95 billion a month. And we just got confirmation that that $95 billion a month isn't going to be starting yet for another 3 months. So they've actually reduced the reduction down to $47.5 billion for the next 3 months. So that's actually less money being withdrawn from the system than what they were originally showing. So again, we're starting to see signs of, all this big big bark, no bite from the Fed. And although it is a reduction in the balance sheet, historically, reducing the balance sheet is never a successful task. If we simply look at the US balance sheet here, this all the way tracks from 2002 and basically to the current levels it's at here. We're now entering this period of exponential growth, and to reduce the balance sheet in this previous cycle in 2015, 2016, 2017, 2018, going all the way into 2019, there was roughly a 15 to 16% reduction in the balance sheet. If we were to reduce the balance sheet by 15 to 16% like the previous cycle, it would roughly take us down to $7.5 trillion. I think that's well within the possibility. The Federal Reserve is actually aiming for $6.5 trillion, which would roughly be let me just get it here, a 27% reduction in the balance sheet. I don't think that's possible. They are certainly not going to be reducing the balance sheet by 27%. That would basically be negating this whole upward move here. I don't see that feasibly possible. They are so leveraged in terms of debt and obligations. They're the biggest indebted nation in the world. And this is going to lead me to the next point, switching into one of the members' questions here. And I'm just going to read out the questions. And essentially, Mante says, I'd be interested in you guys adding in your video thoughts on why we are in this sick situation. In my view, Greenspan is the godfather of the Fed going off the rails. He was celebrated, but all he really did was ride the coattails of Volcker and accommodated markets and government in going even deeper in debt. I've been concerned about this for literally 20 years. I was ignorant on how crazy the Fed could get. Laissez-faire capitalism is dead. I don't know what to call the current environment. You know what? You've brought up some great points, Mante, in this little bit of a write-up here. I absolutely agree with you. It is very sick, the situation, and it's truly monetary warfare on the people's money. And these are the things they don't teach the average person. And literally every day with this money printing over the last several years, and it's not even just been the start of COVID. COVID's been the main hype and trigger, point that people can, throw that easily trigger word to sum up all of what's transpired. Basically, the shit show that's been transpired is blamed on COVID. But when you look at the past history of this balance sheet, it's been expanding at exceptional rates. And when we look at a long-term picture of who did what, certainly Alan Greenspan went through numerous cycles. Alan Greenspan, I believe, started in 1987. He was appointed by President Ronald Reagan as the Fed chair and served numerous terms there. But essentially, when he started in 1987, which is over here, he basically had this first bubble, which was the 1990s recession. Interest rates are lowered to accommodate the economy, and then interest rates rise again. You had another dot-com crash here that Alan Greenspan was in, but again, after the dot-com crash, lowered interest rates. And then over here, he got out right before the housing crisis, but again, what transpired after that was lowering of interest rates and basically supporting the economy. So Alan Greenspan certainly was responsible for starting a major trend over several years as the Fed chair for constantly accommodating the market in times of crisis. And it truly is sick. But if you look farther back, obviously this was your huge inflationary spike in the 70s, early 80s, and this is where Volcker had to significantly raise interest rates to combat inflation. So he really probably had the most daring and trying times as a Fed chair. But when you look at where it started, I think obviously Nixon abolishing the gold standard really kind of broke the economic policy. It was the final straw that broke the camel's back, in the sense that, I think gold was only roughly 30% backed to the US dollar at this point when Nixon abolished it. But there were years before this where they were slowly starting to manipulate gold and do all these fiat currency swaps and all these these tricky IOUs. And that's where our fiat system went downhill. But the real turning point for us here at Trading Capital is obviously the abolishment of the gold standard by Nixon. That just sent reckless politicians on a fiat monetary, sorry, they're not even politicians. We always like to think that the Federal Reserve are politicians because they work with the Treasury and our politicians directly, but the Federal Reserve are private members, and we have to remember that. They are obviously appointed by politicians, but they are private, economists, so-called economists, who seem to always get things wrong. And it truly is scary in the sense that, I don't think these bubbles are ever going to stop. I do think they will stop at some point, but I do think there's probably another 2 to 3 bubbles that our governments can blow up before inflation truly gets out of control. It already is out of control, but I think, in the range of 30 to 50% is going to be the breaking point for the developed countries in terms of inflation. So Nixon was pretty much the trigger point for me when this reckless monetary policy got out of hand. Can we raise interest rates like this? We could, but we would probably be defaulting. The U.S. would be defaulting on all of their debt obligations. So are they going to raise interest rates up there? It's mathematically impossible. Sure, they could say we're raising interest rates up there, but whether or not they can actually do it, I don't think they could ever do that. It just makes no mathematical sense to be able to service the debt that's currently outstanding, sovereign and national debt. So there's multiple cycles that have happened. All of them associate with high inflation, these massive economic downturns where policy has to switch to the tightening policy, and then eventually policy switches to the easing of policy. And the bubbles just, we don't have a free market anymore. It's a very heavily manipulated, macroeconomic driven market that the biggest macro factor is the Federal Reserve. And when will that change? I think they're going to still have a grip on the market for quite some time, but eventually that grip starts to loosen and loosen and loosen until they can't get a grip on it anymore. So hopefully that answered your questions. Hopefully it gave you some insights as to what we can keep expecting. The overall macro trend for the markets is still down. We've had a significant bounce off of the lows, but the markets can go a little bit higher, and we will be looking to short into the resistance if they go a little bit higher, as that risk to reward ratio starts to favor one side of the trade. And we'll just have to progress, and see how things go. There are still some names that are beaten down and could continue to bounce, like Netflix, like Teladoc, the likes of those, Chegg, and we'll just have to monitor